More of those 2023 predictions, trends, and forecasts. Hi, everyone, and welcome to Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, Tim Kent is back with us for the first time this year to catch up on his current thinking. So how are you going today, Tim?
Yeah, good. Thanks, Chris. And yourself?
Yeah, pretty good. It's all really happening, and it's great to have you back on because I've been interested to hear what sort of your perspective is on how we ended up last year, where we are today, and I think also where we're heading. So let's dig straight into that. What did you make of the end of last year? Because it all seemed pretty chaotic, really, to me.
Yeah, I think the market was, because I think the consensus in equity markets anyway was that the first half of 23 was going to be soft or negative. Interest rates starting to bite, top line of companies starting to slow. And then I think that we had a softer CPI number in the US that sort of started to trigger it. And obviously the opening up trade in China started to sort of, investors wanted to get more tilt towards that. You saw the Asian market doing well, and that sort of drew up the US equity market. But the US equity market really drove on that softer CPI number. And then Fed commentary have been around more like 25 basis points, not 50. So the market bond yields, the long end of the curve, fell, and that was obviously helping equities. Growth stocks got a bit of a pop on the back of that. So end of last year was really on the back of a consensus view that the first half would be bad. So obviously, equity managers were starting to position earlier for that. They didn't want to be caught, too long. And then the sort of dynamics sort of changed. And then there has been a squeeze in. Short covering has sort of obviously occurred in equity market. You saw the sort of the high risk end of the market. You saw obviously Bitcoin running. I think that's, look, I don't put a lot of confidence in that. I think its price is just chasing price. Shorts are covering. It's momentum. I don't think it's fundamental driven. I mean, earnings are starting out in Australia, and earnings in the US have been mixed. They're still holding up okay, which has obviously been, putting a bit of a spurt in the Australian market. And you haven't seen that economic sort of slowdown occur. You've had retail. I mean, retail has been a bit mixed, but the feeling has been that, the consumer ended strongly. Property market hasn't fallen apart yet. I mean, I am hearing pockets of the property market in Brisbane. Houses were going for $850 last year, now selling for $750. In that lowest, that range, there's definitely hurt out there. So, that is obviously, everything's just taking a little bit longer to play out. So end of the year, people were positioning, and then they've sort of had to cover positions and also put a little bit of long equity exposure on to not get short. And, other assets have done well, gold as well.
That's interesting because it's a little bit different to what I've heard from other people too. This idea of that short covering, and it has caught people out, absolutely, I think, where they were positioning for a certain outcome at the start of this year that just didn't unfold that way.
That's
but then I wonder, do you think that leads into almost a self-fulfilling prophecy? So can you see the end of a bear market where you actually have the short covering just because people were wrongly positioned? So even if the negative data hasn't really fully come in yet, and we could still actually see that negativity in the underlying market, is it possible that not the market, the economy? So if we see that negativity still coming in the economy, is it possible that the market, being forward looking, can keep moving up from here? Or are you really in that camp that we see another really leg lower because those?
I think the fundamental, I think that's a very good point. I think to keep pushing high, I mean, valuations are now getting full again in the US, if you want to call it, in Australia as well. So to push higher, you would need a soft landing, and you'd need obviously interest rates to the market start to price it in. You need a soft landing outcome. So inflation falling, rates coming off, economy able to sort of hold together, but they'll pull rates back even though the economy is sort of steady, to try and put a floor under it if inflation comes off. So I think I don't think it's the end of it at all. I think it's just the fluctuations in a bear market in the US. So Australia is going to be a little bit different because, but if you've got gold investors, that's a global investment. Obviously, Australian equities Australian equity clearly, but as an investor in Australia, you've got global equities, and that's going to be driven by what's happening in the US economy and Europe. So you've had energy prices come down, long end curve come down, and I think it's still taking a while to play out that the higher rates. And I think that people are going to potentially, there is risk if you're starting to get excited now, because the downturn hasn't sort of played out. Like I said, the market can rally if we have a soft landing and things go, we don't have a slowdown and inflation continues to come off. But the risk that investors need to be aware of is that if we do have a soft landing environment, what's going to happen, what's going to probably put a cap on markets, is that you're going to get inflation. If you have a re-acceleration of economic growth. I'm not sure how that's going to happen, but if we do, then you're going to have rates aren't going to come off. They're going to stay higher for longer. And that's, obviously going to put pressure on valuations of things. It doesn't mean they fall away at all on a soft landing. It means that we trend sideways and maybe go up a little bit. But to go on a new bull market is, it's just not, it's really hard to see that sort of happening. You really need a scenario where economic growth falls, rates are cut, inflation comes off really nicely, and then you get the low interest rate environment, and then you have government stepping in, stimulating, and then you're going to get that rip higher, which might last 18 months. And I
suppose that's I think I've heard it referred to as the black swan is actually that we do get the soft landing. But when you frame it like that, it's really a Goldilocks scenario to get it, isn't it? Like that's a lot of things to line up to really get it.
And you can position for that. I mean, you can have some equity exposure.
Yep.
We've got some equity exposure. I mean, having gold, you need a Goldilocks outcome still going to be positive for gold because, it means central banks are less hawkish, US dollar weakens. So it's going to be positive. So if you've got gold exposure, then that's going to benefit from a Goldilocks. Silver as well, equity markets. So everyone will benefit from a Goldilocks, but how much it really rips is going to depend on, obviously the inflation number. I think you can't get too, you got to just be very open and alert. But I think that in the equity markets, I think what's going to play out is that you're going to have your costs of companies are going to start becoming an issue. They're already starting in the US, but you have the costs becoming an issue. At the same time, your top line is starting to fall away. So you're going to have margin is a risk for companies as you push further into 2023, because consumers are going to start to spend through their savings. Everyone knows there's a lot of savings, but they're going to start spending through. I don't see a GFC type event occurring, but I do see earnings of companies getting reset
and
to
continue pressure on those.
Yeah. So we, look from investing and positioning for clients' portfolios, we've been actually buying defensives because defensives have actually been sold off on this rally, and people have been chasing cyclicals, expecting we're now, entering another upswing. I think they might be right, but I really can't see it happening with the level of debt and rates, going to stay firmly higher. It's not, the mathematics don't really add up on that scenario.
And I think what you've just said there, buying some of those defensives, you would still expect them to perform anyway if that Goldilocks unfolds. Is that right?
That's correct. That's what I'm thinking. Yeah, because they're beaten off. If you look at Coles, Woolies, sort of the staples, healthcare, they've been, they've come off from their highs. So I think, exactly, their earnings are going to do okay, aren't they? They're going to grow. People are going to, PE multiples will expand on the back of that Goldilocks scenario. So PE is expanding. It's going to be good for those defensives as well. So we just see them there's a lot less risk around their earnings, top line, and there's a lot less risk around their margins. So you've got to find companies that you think their earnings can be sustainable on a slowdown. And like I said, we're just at the start of that occurring. It's not like it's just been playing out for 12 months. Rates have been going up for 12 months, or let's say 9. But that effect it normally takes 12 months to play out to 18 months before that starts to really bite. And you're going to start, like I said, you're already starting to see people having to sell their properties. And I think, but unemployment being low is obviously a benefit for people, but if they're very leveraged and they're not getting their pay rises, inflation's starting to bite. So there's a bit of a squeeze there. But, from companies' perspective, inflation is affecting them from a cost line now. There's a delayed effect. Coming out of COVID, it was a really good scenario, like a perfect sort of, you could say a storm, perfect positive outcome, because you had the cost line was just really slow to adjust, but your top line was ripping. And now you're going to get, I think, a scenario where your bottom line becomes quite sticky, but your top line started to fall away. So where does that, you're in gold and silver, where does that play out with gold and silver? I think, they sort of hold around these levels. They might potentially, if we have, more, if fear starts to enter the market again, or, they'll potentially get caught up in it. But the one benefit of Australian gold investors is that, generally in that scenario, you're going to have a strong USD, a weaker Aussie. So that plays out pretty well. But I think looking into, want to talk about gold, if you're looking into the latter half of 23, I think, gold should start to push again as economic growth slows and central banks, you have a sort of garden variety, they call them, recession.
Yeah.
You're going to see them cut a bit. I see a few economists talking 1,000 basis points, so 1% in the US, 1% in Australia by the end of 23. We get that. If we do, gold will do quite well. There's a lot of outlooks out there with gold going to really extreme levels. I think you'd really need a significant downturn to happen, but investors should also be aware that gold does actually quite well, really outperforms coming out of a downturn, like during COVID and stuff.
So you'd be probably, like, specifically with the gold angle there, it's probably more of a long-term prediction that
that's correct.
It does better, because it really is out of that. Everything you've really discussed today, we've got to see all that go, work its way through the system, get that real probably next leg lower that you're effectively predicting, and then it's more of a longer-term prediction then that we get out of that with a solid rally in the metals.
That's correct. And I think the sell-off's going to come in that cyclical area of the market, that higher risk area of the market, your retailers, your miners. I think they'll get affected because they're much more economically sensitive, and they can't adjust their cost line. Their margins have got less predictability in them. So that sector, and look, the S&P, I know we're talking about the ASX, but the US market will lead, as it always does, the rest of the world. And I think 60 to 70% of the S&P 500 is cyclicals. So
that leading, talk with what you were talking about before, that makes a lot of sense, that being cyclical, all of those things, that probably people are bidding up the wrong stocks, aren't they?
I think so, yeah. But it's just, exactly. And it's just that, I think bear markets have that, if you read through history, that it does have those head fakes, and it does have those where people think that's it and they don't want to miss out. And, generally that's not when we've hit the bottom. You normally need a scenario where people are giving up, and obviously they're not prepared to give up.
They're not there yet.
No, I don't want to get too doom and gloom, but it could get. It's going to be interesting. Like people ask me every year is interesting. It's just a matter of your positioning and your asset allocation and making sure. But investors are lucky now because you can get a return on your cash. Yes, I get inflation's running higher, but it's not going to be running at 7 forever. If it does, then central banks will do something about it, won't they? And they'll crush the economy to get rid of it, because they know that. But they'll crush it in the short term, and then they'll swing in and support the economy, with cash and not tax cuts, but and interest rates cutting will drive that sort of rebound. But you would have flushed out that inflation risk. But I think inflation will stay higher. I think there's a risk of that, and I think we're just going to be in volatile times for the next. If you're talking long term, I think we have a weakness. Inflation comes off. Central banks will cut, and then there'll be a re-upswing again. But inflation will come back very quickly, I think, because labour market, as we know, is going to stay tight. You saw yesterday, China, their population shrunk for the first time ever. So that's where that inflation, not all of it, but it's obviously coming from commodities, but it's also coming from the labour market being being unusually, well, now tight, and unless birth rates really pick up, you're going to, that's going to be a
bigger trend that's going to continue.
That's right. You have these spikes up and then rates go up. So rates, I think, are going to stay high for longer, and people need to be aware of that. Unless there's some cataclysmic event occurs. But I think the banking system is better now. We've taken the view, not that we own banks, but I think that the system is much, much better than GFC, and to make a comparison is difficult to do that because they have more cash there. So I think
well, that's really helpful, and thank you for all of that today, because you've really given us quite a lot of overview of where we are right now, but also those predictions, and that's really what that news was about today. So getting a look at where we are, and it is difficult times, and it's going to continue to be volatile times. So things that we need to keep paying attention to and to keep coming back to. So really appreciate, I always find it really interesting to hear your thoughts and predictions on these, because they are always a little bit different to the ones I was sort of having in my head before the conversation. So thank you for that.
You're welcome.
And thanks everyone for watching, and for those of you who made comments and asked questions, keep those coming in, because it really helps us to refine what we're doing. So appreciate that. We always love to hear from you. Reach out on the socials. You know what to do for that situation. So I'll be back again tomorrow with the rest of the Insights team, probably Branko, I think, at this stage. So I look forward to our next conversation then. And thanks again, Tim.
Thank you, Chris.